So liquidity refers to paying our debts as, how convertible, quickly things are convertible to cash. Long-term solvency is talking about paying our debts as they come due. So these are all things that can be evaluated through the balance sheet, okay, by using information that's on the balance sheet. So liquidity is a really easy one because how quickly things are, you can look at what's on the balance sheet. How much cash do they have on hand? How much do they have in assets as far as things that are going to be readily convertible into cash? Okay. We talked about this also last week. The balance sheet misses intangible skills and knowledge of people, right? Because we give the example of Apple, right? And Apple, who is the most valuable person at Apple before his unfortunate passing? Steve Jobs, right? So when Steve Jobs passed, what happened to the stock price right away? It went down. Right? It decreased because there's a lot of value there. A lot of people felt, fortunately that's not, the Apple stock has gone up, but at the time that without Steve Jobs, would Apple be able to continue to do what it's doing? Maybe not, so the stock price will go down. However, none of that's reflected on the balance sheet. Another example, if you talk to people, I don't know if you guys know anyone in the techie world, but if you talk to people who try to get a job at like Google or may work for Google, they have a whole sorts of testing, like IQ type testing that you put you through just to be able to get into that company, right? That you have to get through, several rounds of IQ tests just to get a job. They put a lot of stock in their people, okay? And that's how they feel they're going to get the best people, by going through all this sort of, being able to think outside the box type testing. So. Another piece of the balance sheet, another limitation, it uses judgments and estimates. So can anyone give me an example of something on the balance sheet that would require judgment or an estimate? Yes? Allowance for bad debts, right. So this number is not, as long as you can support the number and it's, and it's deemed to be reasonable based on your argument, this could be the number that's on your books. This can have a very big swing in terms of what your accounts receivable shows up as, right? And in turn, what your bad debt expense looks like on your income statement. Any other examples of things that use judgment or estimates? Sales returns, but that's really going to be income statement, right? But that's also something that requires judgment, yes? Depreciation, well, yeah, in a sense, yes, right, because you're estimating what the useful life is, yes. So the accumulated depreciation piece of it's what affects the balance sheet, right? Based on what you decide for your depreciation overall, yes. Goodwill is usually goodwill impairment may be something that has to be estimated, okay? Goodwill itself gets on your books how? How does goodwill get on your books?
The difference between when you acquire a company, the difference between the market value
and the book, right, whatever, right, if the net assets, right? Assets minus liabilities. If you pay more than that for the company, then this would be, go to goodwill, okay? So, yes, a question? Well, inventory, you may choose, first of all, you have to choose a method for inventory. That's a judgment that you have to make, right? I mean, it's really a choice you have to make more than it is a judgment, right? You might choose LIFO versus FIFO. These are all things that may make the balance sheet not comparable from one company to the next, right? So these are all things you have to consider when you're looking at the balance sheet. Comparability, as you know, is an essential component of the foundation of why, of accounting. Financial statements should be comparable, but if you think about all these things that we just mentioned just right off the cuff here, all these things that require judgment and use estimates, it's very, it's very possible that you're looking at financial statements that aren't quite comparable until you have to make all sorts of adjustments in your, to what you're looking at. So, do you have a question?
Are there intangible assets that are listed on the balance sheet? Do they require judgment?
Well, you have trademarks, right? You have lots of copyrights, things like that. Yes, so there are many intangibles that are listed. Are they requiring judgment? Yeah, I guess to some degree. Some of these would... trademark or a copyright? Yeah, I mean, I'm just thinking, because what goes into to pricing a patent? Because you are talking about like actual fees and things. that are incorporated there. I wouldn't think of intangibles in that respect as being so much of a use of judgment as I would think about their impairment as being something that can be you would use judgment for. Okay. So let's move on from this. And again, as we can even see, this should be used in conjunction with the income statement because, as we even mentioned, the allowance account, for example, impacts what account on that income statement? Bad debt expense. So these numbers work together. Okay, and that's really important. So and I have this here, assessing liquidity and solvency. We went through this, just what these things mean. So how quickly assets will convert to cash? We're talking about what? Liquidity, right? So creditors want to know, can they pay their bills in the short term? Think liquidity. Okay? So that's what one of the things creditors are looking for. And there are ratios that we're going to go over later that evaluate things like liquidity, not just by looking at actual cash on hand, but looking at it versus other items on the balance sheet or income statement. Okay? So this is a very important thing. If a creditor decides to extend you credit, something as simple as, if you work in a business and you want to go to the local hardware store and buy equipment and not have to pay for it right away, these stores have to decide to extend you credit. All right. So in order to do that, they will evaluate things like your liquidity to determine whether or not you're worthy of being able to pay in 30 days or if you have to pay right on the spot. Okay. These are things that you earn. Have you guys ever heard of Dun & Bradstreet? DMB? So that's a popular tool. A lot of companies will use. They put themselves on Dun & Bradstreet to have their credit evaluated. That way they can become more credit worthy and be able to get the businesses to extend them credit. Okay? So does the company have a lot of debt relative to assets? Companies with higher debt are relatively more risky because they have more assets have to meet these fixed long-term obligations. So we're talking about long-term solvency. So what I want to say about this, so what comes to mind for me, which is not really a great example of what's on the balance sheet, but for some reason always just pops into my head when I think of this. So we say here, if more assets have to meet fixed long-term obligations. So don't take this at the very, very at face level. I'm not saying anything political. I'm not saying that our government is failing, nothing like that. I'm just trying to give you a sense, and it just seems very tangible. So when we pay our taxes in every year, a lot of programs that the government runs have been set up forever, right? Like Social Security, right? So whatever we put in for our taxes, a lot of that goes right away into Social Security, right? A lot of what you pay is put aside for some government program that's already there that we they say, oh, we should reduce spending here and spend it here. There's if there's a pool of that goes from 0 to 100, maybe 85 of it is already allocated by things that are fixed costs. We can't do anything about it. So what we have discretion to spend is much less, right? So you put a lot in. So here, if a company has a lot of cash or a lot of stuff coming in, but it's fixed for certain purposes, you have very little discretion on what you're going to do with the rest. This could impact your ability to continue in the future if you have all these fixed costs, right? Okay, so it can affect long-term solvency. All right, so I'm not saying anything about the government. I'm not making any statements. I just, that's what always comes to mind when I think about, just having a lot of fixed costs that you don't have a lot of discretion on what to do with the rest. Okay. So, and obviously, if you have, depending upon your liquidity, depending upon how much of your assets are fixed for spending on certain items, this can affect how flexible you are financially. And how flexible you are financially may impact your ability to get additional loans. Okay, so if you have, if a creditor gets the sense, or not the sense, that they look at your financial statements and they see you have $10,000 coming in cash flow every period, and 8,000 of it is already allocated to other loans and other fixed costs that you have, are they likely to lend you money? Because you may not have enough, depending upon what you want to borrow, you may not have enough financial flexibility to really be able to take on new loans and be solvent in the future. Okay? So that's liquidity, long-term solvency. So classifications, we've talked about this, current versus non-current. Okay, I gave you an example. I said current is anything to be consumed within 1 year or operating cycle, whichever is longer. Do you remember the example I gave you last week? Yes.
Winemakers' operating cycles are often a lot longer than a year.
Right, maybe longer than a year, exactly. Because why? They have to wait for the grapes to ferment. So it's cash to cash, raw materials to collecting cash on a sale. Yes. Yeah, I mean, I'm unlikely to give you something that has some strange operating cycle. What's important is that you know when you go into the real world, okay, that you may encounter companies that have an operating cycle that is more than a year. Okay, it's possible. Okay, you know, it may not be likely depending upon the type of company that you're working with, but this is a possibility. Okay, I have that here. Current assets. So we kind of went through all this. I feel like we can not spend too much time here. And these are just different types of assets that go on that you see on the balance sheet. Okay, I had kind of skipped this. I just said current assets, usually cash and cash equivalents. Short-term investments, accounts receivable, notes receivable, inventory, prepaids, usually are within a year. We have investments here. Investments can be classified either as current or non-current, depending upon how your business uses those investments. If you plan to sell them off and trade them within a year, then they'd be considered current. Otherwise, they can be considered non-current. Did we go over trading available for sale and held to maturity? Okay. So there are different classifications of stocks or investments. Trading, available for sale, AFS is available for sale and held to maturity. So depending upon, trading securities would generally always be considered short-term. Available for sale, it could go either way. Held to maturity are likely to be non-current. So the way that I like to explain these kinds of securities, so trading, I like to say you're like out there and you're just like dating. You go on like a few dates a week. You're like constantly, you know, have like a new guy, you go out, or new girl, whatever you do, right? So you like have a date on a Friday. Sorry, that's trading security, okay? Available for sale is like I'm going steady. I'm holding on. We're like not totally serious, but we're like going, you know, we're like dating. We're like, I might call that person my boyfriend or my girlfriend. And held to maturity is like, you know, I'm in it. I'm getting married, okay? We're like in it for the long haul, okay? So that's kind of like how I would think about those three different classifications. So if you're trading security, you're likely to be short term. If you're available for sale, you know, it could go, you know, like it could be either way. And if you're held to maturity, that is non-current, right? You would hope that there's nothing currently happening, okay? So trading securities, I don't know how much I want to get into this. Trading securities, the really big difference outside of the classification on the balance sheet is that on the income statement, trading securities, you recognize unrealized and realized gains and losses in income. Available for sale securities, we did something with that. Realized gains and losses go on the income statement. Where do unrealized gains and losses go?
Comprehensive income.
Into comprehensive income, right? They're that like other, they bypass the income statement and go directly into comprehensive income. Okay? Yes?
Trading securities do go into?
Trading securities go into income because realized and unrealized gains and losses go into income. Okay, if they're classified as trading. Because the idea is that it's all short term. Held to maturity securities are recognized at what's called amortized cost. Okay? We're not going to get into what that means right now. Just be aware of this. Okay, we're not at that point just yet. We will get there. Okay. Property, plant, and equipment. I feel like this kind of goes without saying. You've taken an intro class. You should know what these things are. Intangibles. We were just talking about that before. So goodwill is not the only intangible that ends up on your books. You have lots of other intangibles that you can show on your books as well. Other assets, just it's a catch-all for things that don't go other places. You have current liabilities. I mean, does anyone feel like I need to talk about what these things are? Current, what the same idea, current, 1 year or operating cycle, whichever is longer, okay? So you classify things as current, long-term, or beyond a year. You have the equity section, you have your paid-in capital, your retained earnings, and you have treasury stock, which would be in your equity section of your balance sheet. Never going to have that on. Okay. So, so as I was saying, and for anyone who actually ever listens to this, so on an income statement, sales goes with what account? Cost of goods sold. Does rental income belong with cost of goods? Does it have a cost of goods sold? No, so that would go separately below. Okay? Here, accounts receivable goes with the allowance for doubtful accounts. Does notes receivable generally have an allowance for doubtful accounts? No, it goes with accounts receivable. So on your balance sheet, even though may have more than one kind of receivable, the allowance account goes with the receivable account that it relates to. So you don't list all, because I can see some of you may want to list all your receivables, then the allowance. Put it with the account that it belongs with. Inventories. In order of liquidity here, you have your finished goods, then your work in process, then your raw materials. So again, this is a lot of detail. You won't always see all this detail on a balance sheet. You may just see inventory. Okay, here we're choosing to put a lot of detail in here. Next, we have long-term investments. This may just be called investments. If it's just called investments, what's the assumption? That it's non-current. There goes to your, here, this says long-term. I would call this non-current. Okay? So preferred stock, land held for future plant expansion, or land held for future plant site, cash restricted for future plant expansion. These are considered investments. Like I said, you take that money, you're putting it aside for a separate purpose. Property, plant, and equipment. Again here, buildings less accumulated depreciation. Now, a little differently from what I said on the other items, sometimes, or frequently, you'll see buildings, equipment, whatever, buildings and equipment, and whatever else, furniture, less accumulated depreciation. So these won't always, oops, where'd I go? Come back. Oh no, I have to. Oh my gosh, what did I really just do that? Okay. So these won't always have their own accumulated depreciation account broken out separately. Okay? In this case, this says buildings less accumulated depreciation buildings. So the idea is there, I guess if there was equipment, it would say accumulated depreciation equipment. However, know that on a balance sheet, you'll very frequently see buildings, equipment, furniture, less accumulated depreciation. They're not always broken out separately. Yes? Yeah, so if you have $1,000 of cash and $50 of that is restricted for future plant expansion, what's the amount you're going to show for cash? $950. That's what that's saying. Whatever you have for cash less that amount, that $50 is in here. They're just showing, they're giving you way too much detail up there. They want to be clear that the cash that's restricted is not included there. Okay? Yes?
Short-term investments like trading securities,
Mm-hmm.
does that just get converted in with cash and cash equivalents?
No, it doesn't. That's a good question. That would be like T-bills and things that are due within 3 months, generally get classified as cash and cash equivalents. If you had some kind of trading, investment in trading securities, it would be part of your current assets. It would be listed as one of your current assets. But it would likely say short-term investments or something. You would just have a line there. Yes?
The cash restricted for plant expansion, because it's for the plant, would it be under?
No. It's not going to be listed under property, plant, and equipment unless you've already started like constructing the site and doing something like that. Then it would be in some kind of property, plant, and equipment. Okay? Intangible assets, you have copyright there. Liabilities, so you have all your current liabilities listed. Then you have your long-term debt, minus any discount. Okay, so premiums and discounts. So someone asked this, I want to make sure I point out. So premiums and discounts are not things that are necessarily paid over the course of a year. They're things that are amortized. So what you're going to pay within the course of the year would go into current. Everything else stays into the long term. So your premiums and discounts are going to end up with your long-term debt. Then you have your stockholders' equity section. You have common stock, additional paid-in capital, retained earnings, less treasury stock, and you have your total stockholders equity, and then you have your total liabilities and stockholders equity. And this number always has to equal what number? Assets, right. Okay? So if they don't equal, you've done something wrong. You have to go back and find your mistake. Okay? If your trial balance balanced, then your balance sheet needs to balance as well. Okay? Any questions?
7%.
Yes, absolutely. So what we're going to do now, I'm going to go through some financial disclosure stuff, and then we're going to take a break, and then we're going to get into cash flows. And I can also leave this up during the break if you'd like. Okay? How about I do that? Do you mind if I go on and I'll put this up during the break so you guys can finish it? Is that all right, just so we can get through what we need to? All right, so in addition to reporting your balance sheet, your income statement, your statement of cash flows, statement of stockholders' equity, you also have to incorporate disclosures in the back of your audited financial statements. Companies will always have disclosures in addition to the actual financial statements, the numbers that are presented. And this is required, this full disclosure principle, one of the principles that we discussed in the foundation or the fundamentals of accounting. We have to supply all relevant material, okay? Just the financial statements themselves don't provide all that information. So for example, if I was to go back for one moment to this, buildings less accumulated depreciation buildings. What depreciation method do I use? We don't know. It doesn't tell us that information, right? Inventories. What method do I use for that? We have no idea. Okay? What's my discount on my bonds? Well, actually, we know we know the current year's discount. We don't know what it's going to look like in future years. There's lots of information that when we think about it, we don't really know just looking at the face of the financial statements. So disclosures, supplemental disclosures provide this information and are always, always required to be part of your audited financial statements. So these are called disclosure notes. So you're always going to see in your disclosure notes, I'm going to call it, I'm going to refer to it a little bit differently from what the book does, just to give you a general framework. So the first thing you always have, your first note, is always the summary of significant accounting policies. The summary of significant accounting policies is going to tell you the method that you used for everything. We depreciate our fixed assets using the straight line method of depreciation. Buildings are depreciated under 39 years. Equipment is depreciated using 10 years. Whatever. Okay, whatever it is that you do. We record our inventory using the LIFO method of inventory. We report at the lower of cost or market. Okay? These are the types of things that would be disclosed under the summary of significant accounting policies. Are your methods. Have I said anything about numbers, amounts? No, I've just told you methods. So under the summary of significant accounting policies, you're going to see methods for things, not amounts. So if you were to take a look at any financial statement, any audited financial statement, at the end, after the financial statements, you'll see footnote disclosures. Those note disclosures are going to start off with the summary of significant accounting policies, and you're going to see lots of information that tells you what methods they were used in those financial statements. But it's not going to give you what the amount was for the year. So as an example, So I told you buildings, it would say we depreciate using the straight line method, blah, 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 for buildings. For this, we use 39 years for buildings. We use 10 years for equipment. On the balance sheet, I told you a lot of times you'll see buildings, equipment, furniture, and it'll just say less accumulated depreciation. Right? It'll all be kind of clumped together. So whereas in the first note, in the summary of significant accounting policies, it'll give you some detail about how they came up with that number. In other notes, so this is how I say it. I call it summary of significant accounting policies and other notes. That's how I look at it. Okay? In the other notes, you may see a detailed breakdown. Buildings, 39 years. This was the current year's accumulated depreciation. Equipment, 10 years. This is the current year's accumulated depreciation. The total equals what's on the balance sheet. It might give you more detail than you see on the balance sheet in the other note. So you may see a fixed asset note 2 times, something related to fixed assets. The first one will tell you the method. The second one may give you more detailed breakdown of the amounts. Does that make sense? So you're going to have 2 overall categories: summary of significant accounting policies and other notes. It's not that you're going to see only 2 notes. It's that under summary of significant accounting policies, you're going to see a note for cash and cash equivalents. It's going to say, we consider anything to be cash that has a maturity date within 3 months. That includes U.S. Treasury bills, bank accounts, money market accounts, blah, 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 blah. You may see another note that actually breaks down how much of the cash is Treasury bills, how much of it is straight cash in your bank account, how much of it is money market accounts, things like that. So you may see each of these things twice, once with a method and once with more detail, and that detail has to tie back to what's on the balance sheet. Okay? Make sense? So you're always going to see 2 overall categories. The first is a summary of significant accounting policies, and the second is going to be what I call other notes. Okay? And under other notes, there could be a whole plethora of things. I'm just giving you one idea of what can be in other notes. Yes? Yes, because and part of that is that's part of what you're auditing, right? So if you go in to audit a company and you look at their fixed asset schedule, what is one of the things you're looking at is how they depreciate, right? They're depreciating their buildings under 150 years. That doesn't make any sense. We have to give them this reasonable numbers. We have to adjust that. So you know based on auditing what these things are, based on going through, because you have to make sure they're complying with GAAP or some reasonable method that they're using. You know if you're auditing their inventory what method they're using. So, and a lot of these footnote disclosures, they're required footnote disclosures. So you already even have like a template. You know what you have to incorporate. Okay? But there may be things that are not template type disclosures that have to be made. So, like I said, we always have our summary of significant accounting policies first. Next, you have to report in a footnote disclosure if there's some significant development, a subsequent event that takes place after the fiscal year end but before the financial statements are issued. So maybe there was some kind of dividend that was issued. You would report that in a footnote disclosure even though it didn't necessarily happen before the fiscal year end and doesn't necessarily get recorded in the balance sheet. Okay? If you have related party transactions, if you're making significant loans or something to related parties, you have to disclose this in your footnotes. Okay? Does that go in the summary of significant accounting policies? No. If you were to say, for all related party transactions, we have this method we allow all related party receivables to pay us back within a certain number of years, or whatever the method is that you use, or the rule is that you use, that could go into a significant accounting policy if it's something that's related to how, but not what. Okay? So the related party transaction, the detail and the dollar amounts would always be in some other note. Okay? Any contracts that you may need that are significant, that may need to be spelled out, would have to go into an other note. Contingencies. Litigation is a very popular one. Okay, there are different levels of disclosure for litigation. Often companies are involved with lawsuits, and they don't necessarily know what the outcome of that lawsuit is going to be, but it may be material to the company's financial condition. Okay, so a lot of times what companies will do is they report in a footnote disclosure that they're in litigation. Depending upon how certain they are about the amount, they may have to report some dollar amount. Otherwise, they may just have to disclose that they're in litigation and the outcome is uncertain. Okay? You also have to report the fair value of certain financial instruments as of a certain date. So you're giving detail about information that's on the balance sheet. That's what your footnote disclosures are telling you. So again, just highlights from that. The summary of significant accounting policies includes methods, i.e. of depreciation, and the basis. Okay? How do you recognize revenue on long-term contracts? It's going to give you methods for things. It's going to give you the basis that you use, but it's not going to give you any particular number. Other notes, composition of accounts, is going to be in this other notes. And all of these other items that I discussed. Okay? If they're not methods, then they go into other notes. So I think I included here, I'll just give you a minute and then I'm going to just show you what something like this would look like. Just kind of copied this. Can I skip to the next slide? So just to show you, at the end of your financial statements, you have all your basic financial statements, balance sheet, income statement, statement of cash flow, statement of stockholders' equity. You'll see the first thing, summary of significant accounting policies, note 1. That's your first note, is your summary of significant accounting policies here. Principles of consolidation. Your cash equivalents, it considers all highly liquid investments with a maturity date of 3 months or less to be cash equivalents. Inventories are stated at the lower of cost or market, blah, blah, blah. Plant and equipment are carried at cost less accumulated depreciation. We have lives ranging from 2 to 7 years, blah, blah, blah. Revenue recognition, we recognize when payment is tendered at the point of sale. And they go through all this. So do you see any numbers in there? Just telling you. It's telling you how they derive the information that's on the financial statements. Now, this would be an example of an other note. Subsequent events. On March 8, 2013, the company's board of directors approved an increase in the annual dividend to 88 cents per share. The annual dividend will be paid in 4 quarterly installments over the course of the next year. On February 2013, they announced a purchase of a 35% interest in some other company. These are significant events that happened after the balance sheet date, but before the financial statements were reported. This is considered an other note. So this is listed as note 14 I must have pulled out from something. Okay? So that means there's like a whole bunch of other notes that are considered other notes that also may have been incorporated into these financial statements. I'm just pointing out one example of an other note versus a summary of significant accounting policy. No, that's always the first note. Okay? So I have here a little thing here. Let's try classifying. The summary of significant accounting policy, or is it an other note? Inventory costing method. Yes. Information on related party transactions. Composition of property, plant, and equipment. B, composition, detail, not method for reporting property, plant, and equipment, the detail in that account. Got it? So you may report on your balance sheet property, plant, and equipment, but not have a breakdown of what's building, what's furniture and fixtures, what the depreciation is on each of those items. You would have that possibly in another note. Okay? Depreciation method. Good. Subsequent event information. Good. Basis of revenue recognition on long-term contracts. Important merger occurring after year end. Is that like an after I already give it? That's a safe bet. After the answer is up. Composition of receivables. Good. If it said method for reporting your allowance or method for reporting receivables, then it would be A. Okay? So that's really through that. Last couple of things I want to touch on before we take a break that are also part, so we could just kind of get through what's in the overall audited financial statement. So now we've gone through income statement, we've gone through balance sheet, we've gone through notes in the financial statements. We haven't gone through cash flows yet. In a financial report, an annual report, management also includes a management's discussion and analysis. You'll see this. This is management discussing the results of their operations. This is a biased report. That's what's important to understand here. It's very informative, but it's biased, and it's from the perspective of the company. Okay, their management's discussion and analysis. I have just an example of one in here. You know that we have management, since Sarbanes-Oxley has a responsibility also to report their assessment of internal controls. This is all part of the annual report now. Okay? I'm just kind of pointing this stuff out to you. There's also an auditor's report, which we've gone through. You guys are all taking auditing. I don't want to get too much into that, but you see the auditor's report always as part of the audited financial statements. I don't think we even really need to get into this proxy statement stuff. Risk analysis, I'm going to stop here and let you take a break. I think what I'd like to do is start off after the break with the statement of cash flows, and I want to come back to risk analysis at the end. Maybe we'll end up at that next week. Okay? All right. If you guys can take your seats, let's start where we, not exactly where we left off. I want to skip the liquidity ratios and the ratio analysis. We're going to come back to that at the end of this chapter. But I just would like to get into cash flows today. So I'm going to go through an introduction to cash flows. Again, I'm going through the basics just to make sure everyone is on the same wavelength, and then we're going to get into the prep of a cash flow statement, or as much as we have time for today. So, all right, so far, up to this point, we've learned about the balance sheet. And what does the balance sheet tell us? Financial position for what types of, so what do you think of? What are the sections of the balance sheet? Assets, liabilities, and equity, right? As of a particular date. I think it is. Thank you. I hope, well, actually, let me just see. I put it on, but knowing my luck, it will not be actually. Let me just make sure that it actually has sound. Hello? Yeah, okay, it's on. Yes. Good, thank you. So now you can actually get this information somehow online. I don't know when that'll be, but all right. So it tells you your financial position at a particular point in time at 12/31/2012, okay, or as of, okay, but it wouldn't say for the year ended. We learned about the income statement, and in the income statement, what are we looking at? Revenues and expenses. What else? Losses and gains, yep. So that's going to tell us the profit-generating activities for a particular period. So you're going to see something like for the year ended 12/31. Okay? And I have here GAAP generally requires the use of accrual basis financial statements, right? So we're focusing on accrual basis. In the income statement, we're focusing on accrual basis for the balance sheet. And we've also learned about disclosure. We talked about financial disclosure up to this point, which is required as a supplement to these statements, right? Unfortunately, the accrual basis financial statements are not giving us the whole story that we need to know. The accrual basis financial statements plus all those disclosures are not telling us everything we need to know. So for example, we can have lots of sales, but not collect a lot of cash on those sales. Okay? We could have great salespeople, but not good collections people. Okay? So these accrued sales are going to increase our net income, but they're not going to reflect how much cash we've actually received. So you can have many transactions that will increase your net income, but have absolutely nothing to do with any cash that you've received. And this is accrual basis financial reporting. That's what it does. On the flip side, yes. Oh, yes. Okay. So again, on an accrual basis, when we report our sales, we're reporting sales that we have made, okay, revenue we've earned, but not necessarily the cash we received on those sales. On the flip side, I'm going to get ready to scroll over, we can incur expenses. We can get a utility bill, a phone bill, but we may not pay that bill by the end of the period. Okay, so we can incur expenses but not pay on those expenses. We all know those times when we get our cable bill and we just decide we're not going to pay it for a while until the company says, better pay it, or we're going to send you to collection, whatever they say, or we're going to turn you off. Okay? So sometimes we have expenses that we don't pay in a timely fashion. So these expenses that we accrue are going to decrease our net income. But they don't reflect how much cash we've actually paid. So we have transactions going in both directions on our income statement that have absolutely nothing to do with any cash we received or any cash we've paid. Okay, any questions on anything I've said so far? This is intuitive, makes sense, right? So far we've kind of pointed out that using the accrual basis, we can get information about our net income, but we don't necessarily know what kind of cash has come in or what kind of cash has come out. In addition to that, we can also receive money or pay money that is not related to our primary business purpose. So many companies, I've used this example before in this class, companies may sell property. Okay, I even say we can buy or sell a building and receive money even though that is not our primary business purpose. So you can have a company that has a big infusion of cash, right? They have a ton of money in their bank account, but it turns out, I think the example I've used here in the past is they sold a building in Manhattan that they bought 100 years ago. It's worth millions and millions of dollars. They sold it. They have a big infusion of cash. By selling that building, they receive money, but that's not, is that likely to happen next year? No, so they may have a big infusion of cash now, but is that going to help keep them afloat in the long run? No. So these transactions may increase or decrease our cash balance on the balance sheet, but it's not related to what we do primarily as a business. So far we've noted that on our income statement we have lots of things that may increase income or decrease income, but don't reflect any kind of cash that's come in or out. And then on this flip side of that, we can have things that increase or decrease cash on the balance sheet that may not happen again, right? They just may be a one-shot deal. Do you need me to? Okay. I have too many blanks on this one? Okay. Okay. So where we're going to go next, there's another way you can receive money that can give you a big infusion of cash. Any thoughts on what that could be? Loans. That's exactly right. So you can receive money from buying, or I'm saying receive money. You can also pay money to buy an asset, like a building, but I'm using the receive money. But you can also receive money from a loan, or you can, on the flip side of that, repay some loan. Okay, and this also will impact your cash balance, right? You may have a lot of cash coming in from a loan or be paying out a lot of cash that you owe on a loan. So this transaction will also increase or decrease cash on the balance sheet, but it is not, again, cash from primary business operations. So again, why does that matter? Why do you think that matters? Where the cash comes from? Yes?
Determining future performance.
Right. Is this determining not only future performance, but the future ability to continue to exist? Right? Solvency. Are you going to be able to continue? You may have a lot of cash now, but are you going to be able to continue to exist in the future and meet your obligations if you don't have cash coming in like that in the future? So the bottom line in this just beginning of discussion about cash flows that we're getting into is all sources of cash are not equal. If you were going to invest in a company, where would you want to see that cash coming from? Operations, right. Not from selling a building necessarily. That might be a nice thing to have, okay? It may be nice to know that they're investing in a building if you're thinking about investing in a company. Why? What can that be a sign of? They're trying to grow, right? They may be making decisions that are in the growth direction, okay? So there are different reasons why you may want to see different things happening, but in general, if you see a company existing on loans and selling its assets, that doesn't say a lot for the company's ability to continue to exist as a profitable company, okay? Because that might be something they're doing to try to stay afloat, okay? So, the statement of cash flows is very important because the things that I've talked about so far, I said, we know that there are things that increase or decrease net income that don't affect cash. Have we learned anything that tells us what affects cash yet? We haven't learned anything that specifically says the cash that we received on sales or the cash that we paid on our bills. We haven't looked at anything like that. We've looked at the income statement on an accrual basis, which tells us only the sales that, the revenue earned and the expenses incurred, okay? We can find out what our cash balance is on the balance sheet, but we don't necessarily know where that cash came from, okay? And so seeing a high balance or a low balance in our cash, specifically looking at cash may give us an indication of our liquidity at that time, but it doesn't necessarily tell us where that cash came from to tell us how we're going to be able to do in the future. Okay? So the statement of cash flows tells us this information. It provides us with this incredibly useful information. It tells us how much cash we've received and paid during the period to operate our business, how much cash we've received or paid from investments that we've made, which are these more peripheral transactions. So here in the operation of the business, we're talking about how much cash we've received or paid on these sales or on these bills. When we talk about cash received or paid on our investments, we're talking about buying a building, selling a building, something like that. Okay? And it also tells us how much cash we received or paid in financing of the business, which would be like these loans that I use as an example. Okay, if you're taking out loans or repaying loans, issuing stock, paying dividends. These are all activities related to financing. So, as a result of this, as a result of the cash, because the cash flow statement tells us this information, it is split. And I say here it's reported in conjunction with the balance sheet and the income statement. But because it is split between telling us about operations, investing activities, and financing activities, does it make sense now why it's split into these three sections? Because they each have different important purposes. We need to know how much cash came in to operate our business. How much cash are we getting on these sales? How much cash are we paying on our expenses? We need to know how much cash are we paying or receiving to either sell off our investments. Is that what's making our cash balance high? Or are we investing in something which could be an indication of future growth, like we said? Or are we financing things? Which can also be a sign of growth or be a sign that we can't obtain finance, we can't get enough cash elsewhere. So the cash flow statement is split into these three categories: operating, investing, and financing. OIF. O-I-F. OIF. That's the order. It always is in that order. Any questions so far on anything that I've talked about? Okay, so I'm starting with the basics. Again, none of this should be totally new. However, I want to make sure I start here to make sure that the cash flow statement makes sense to you as we delve into it. Okay, rather than just starting with the mechanics. So, operating activities we're going to look at first. So the income statement includes, we know this, revenue earned and expenses incurred during the period. And I'm repeating this, regardless of whether cash was actually received or paid. Because on an accrual basis, do we care about cash received or paid? No. If we don't care about cash received or paid on an accrual basis, is it still important? Why again? Why might again it be important? Yeah, I mean, well, accrual is important, right? Because it's telling you what's actually right, what actually is earned or incurred during the period. But why is that not the big picture again? I've been saying this. I just want to make sure people are getting this. Why is that not the most important necessarily? Not maybe it's why are there other pieces that are important? I should say.
Like in terms of the other, like it's not as important. So it's not as relevant because you don't actually have it yet. So like you might be predicting it wrong. You don't know necessarily.
Right. You don't know if you're going to get all of it. And can you, if you don't receive cash on your sales, can you pay your bills? And if you can't pay your bills, what happens? Right. Creditors are going to come after you, and you're going to not be able to continue to exist. So you need cash to be able to exist. So regardless of whether or not accrual basis tells us what we actually earned during the period, what we actually incurred during the period, that's all lovely. And it's all very important. However, without cash, you cannot exist. Right? Without having cash to pay your bills, you can't exist. You will become insolvent. So, so whereas the income statement tells us what's earned or incurred, the operating section of the statement of cash flows tells us cash received or paid for the elements of the income statement. So some people would call this like the cash basis income statement. That's kind of like what the operating section looks like, particularly in the direct method, which we're going to talk about later. So it tells us cash received or paid for the elements of the income statement. So for example, Amazon Inc. sells goods to customers on account for $100 during the month of March. They incur $70 of expenses to operate. As of the end of the month, customers have paid $5 on their outstanding balances, and Amazon has paid $55 of their outstanding bills. So let's see what this looks like on an accrual basis. It's a little bit messy here. On an accrual basis, you have sales of 100 and you have expenses of 70 for a net income of 30. That's clear, yeah? Okay. On cash, in the cash flows from operating activities, wow, this is all a little messed up. You have cash received from customers of $5, this should say, and you have cash paid for operating expenses of $55, showing net cash flows from operations of negative $50. So this is an accrual basis income statement. This is the corresponding statement of cash flows in the operating section. Okay? So here, Amazon has positive net income, but they have negative cash flow from operations. So if you were just looking at this, what do you see? They did really well. They exceeded their expenses. Well, they did really well, whatever. In a simple world, they did well. They made more money than they spent. When you look at it from this perspective, what do you see? They're not taking in enough money to cover their bills. Okay? So you need to look at these two in conjunction with each other to really get a good full picture of what's happening with the company. Okay? Now, investing activities. Companies, I gave you buying or selling a building as an example. So companies may invest in assets. I gave you a building as an example, but they can also invest in stock of another company. Okay? So I gave the example in class before of Amazon can make an investment in Yahoo. Right? If you're a company, you can make an investment in another company. Or alternatively, they can sell these assets during the period. These are called cash flow from investing activities on the statement of cash flows. They involve changes in non-current assets. This is very important. So whereas the operating section, we're talking about changes in net income. We're looking at elements of the income statement. And we should say also current assets and liabilities. Cash flows from investing really involve changes in non-current assets. So I have here cash inflows in the investing section. If you sell property, plant, and equipment, what kind of asset is property, plant, and equipment? Non-current. If you sell investments, what are those generally? Non-current, unless they're short-term. If you are collecting on loans, you're generally talking about something non-current. They're generally non-current assets. Cash outflows. If you, instead of selling, you could be purchasing property, plant, and equipment, purchasing investments, or lending to others. Okay, so they generally involve changes in non-current assets. And I've already said, I don't know what it's doing there, these transactions provide clues to what the company's future plans may be. So by investing, I say buying new land or a new building can indicate the company plans to expand. We got there already. So operating, we're generally looking at elements of the income statement. Investing, we're looking at non-current assets. Give you an example. Oh, sorry. Okay. So I'm going to go through an example shortly of the investing section, then we'll go through the financing. Okay, can I move on? Okay. So for example, Amazon Inc. purchased land for $500,000 in common stock of Google for $25,000 during the month of March. So where would that land generally end up? You purchase land for $500,000 on your balance sheet, right? So PP&E is a non-current assets on your balance sheet. If you purchase stock of Google for $25,000 during the month, generally, where would that go? Investments, non-current assets. So here you are, you have this stuff on your balance sheet. These items end up on your statement of cash flows. Again, this is just, I don't know why this got messed up. Purchase of land, cash flows from investing activities. Purchase of land, negative $500,000. It should be here. Investment in securities, negative $25,000. For net cash flow from investing activities of negative $525,000 during the month. Okay? And I've already said this. Note that they involve changes in non-current assets. Financing. When companies make investments, they need money to pay for them. So sometimes these investments are paid for with external funding. So you might take out a loan, you might issue stock. So cash flows from financing activities involve changes in non-current liabilities and stockholders' equity. So changes in non-current liabilities and stockholders' equity are going to be shown in the financing section of the statement of cash flows. So again, you make investments in that new building. If you need a way to pay for it, you may take out a loan, you may issue stock. So those types of things, non-current liabilities, changes in non-current liabilities, and in stockholders' equity, end up on the statement in the financing section of the statement of cash flows. So I have here cash inflows will be from borrowing or issuing stock, and cash outflows would be repaying debt, excluding interest, purchasing treasury stock, or paying dividends. Those will end up in the financing section. Interest expense would end up on the operating section. Right? It's part of your income statement. It's an element of the income statement.
The interest is part of the financing.
The financing is the debt itself. The interest is you incur it in the course of operating your business. So it would end up in the operating section. This is like you're thinking here like the principal. Okay? So let's look at an example. So to pay for the $500,000 purchase of land, Amazon took out a loan of $200,000 from U.S. Bank and issued common stock for $300,000. So in the cash flow from financing activities, issuance of common stock $300,000, loan proceeds $200,000, net cash flow from financing activities $500,000. So again, just to reiterate, the financing activities involve changes in long-term liabilities and stockholders' equity. So if I ask you what would be found in the investing section, what are you thinking about? Non-current assets, right? If I ask you what's included in the operating section, what are you thinking about? Elements of the income statement, and I should also say current assets and current liabilities. So they have to go somewhere too, okay? That depends, and you'll see why that is in a little while. Because those are related to the income statement. And if I ask you about financing, now you're thinking about long-term liabilities and stockholders' equity. But intuitively, what I think will get you here to understand this, or to get you to be able to do a statement of cash flows and get it, is understanding why it's split up and what each different element of the statement of cash flows tells us. Okay? So if I'm interested in seeing if this is a company that's growing, which sections of the statement of cash flows am I more likely to be interested in? Investing and financing, yeah. If I'm looking at whether or not this company is able to continue to exist and as a profitable business, you're looking really more at the operating section. Okay, so depending upon what you want to know will impact which statement of the statement of cash flows you're more interested in looking at. Okay. So if you were to take these three pieces in total that we just went through and create a statement of cash flows, so you just take the stuff we did with operating, cash received from customers 5, cash paid for operating negative 55, gives us cash flows from operating activities of negative $50. Cash flows from investing, we have our purchase of land and our investment in securities. We have net cash flows from investing of negative $525. And cash flows from financing, issuance of common stock, loans proceeds, gives you our net cash flows from investing of $500,000. So our net decrease in cash is negative $25,050. If our cash balance on March 1st was $100,000, then our cash balance on March 31st would be $74,950. So what should this number tie back to? Cash on the balance sheet. This should be cash on the balance sheet at the end of the period. Okay? It's kind of like a roll forward of cash from beginning of one period to the end of that period. Okay? Any questions on what I've gone over so far? Okay. So there's one more piece I want to go through before we start to get into any exercises with this. And that is significant non-cash activities. So sometimes you may have something that happens, like you issue stock in exchange for property. Does that affect cash? It kind of bypasses cash, but it's a significant activity. These items have to be reported. They're usually reported at the bottom of the statement of cash flows or in the notes to the financial statements. So examples, purchase of assets by issuing stock. Converting bonds, let's just say, into common stock. Okay, so these aren't directly impacting cash, but it's almost like they're bypassing cash, right? You could issue stock, get cash, and then buy assets. You could sell you could sell your bonds and then purchase common stock, or purchase bonds and then issue common stock, I should say. Or you may exchange long-lived assets. You may exchange one property for another property, which you're kind of bypassing. You could have a property, sell it, and then buy another property, or you can just do some kind of like-kind exchange. So these are areas that have to actually be reported. So they're considered significant non-cash activities. And they're usually reported at the bottom of the statement of cash flows. They're not part of the statement of cash flows because did any cash change hands? No, so it's not incorporated into operating, investing, or financing. It doesn't come into your bottom cash number, but they're reported in that same area, generally, or in the notes. So I just took this out of your book. Presentation of material non-cash items. So if this was the end of a statement of cash flows, you might, right below that, have non-cash investing and financing activities. And this information is reported. It doesn't tie back to your cash balance. It's just giving significant information. Okay? Another way of presenting it would be a note in the financial statements. Same thing. Okay? All right, so let's look here. Let's try classify as operating, investing, or financing. A building costing $120,000 was purchased for cash. Inflow or outflow? Investing, outflow. Equipment costing $25,000 was also purchased for cash. Investing, right? Equipment, you're purchasing equipment, you're investing, right? Issued common stock for $20,000 in cash. Good. Cash sales of merchandise. Cash paid for merchandise. Good. All right, so just wanted to make sure we're on the same page here. Now the statement of cash flows that I showed you, that we put together here, is under the direct method. Okay, that like the format is under the direct method. Okay, the big difference, and we're going to talk about this in a moment, is really in the operating section. But what I've shown you at that point, that full statement of cash flows, you may want to note that is on the direct method, not the indirect method. So take a look at exercise 5.13, and you're going to be doing something similar to what you did here, just classifying as operating, investing, or financing. Exercise 5-13. So that's why cash is important. Cash is important to investors and creditors. So investors want to know, are we going to make money? Am I going to make money? Right? Because we use cash to pay our dividends, right? We use cash to pay our bills. So investors are going to make money if they receive dividends. They're going to have dividend income. If their stock price goes up, they're concerned about cash for these reasons. Creditors want to know, will the borrower be able to pay back the loan? Will they be able to pay their bills on time? So they're concerned with cash, not just accrual basis figures. So the bottom line in all of this, in this discussion of cash flows as we are starting to delve in, is that we use cash, not net income, to pay our bills and to pay dividends. Without cash, we can't pay our bills or pay dividends. We receive cash. We can receive cash from sales. We can receive cash from investments. We can receive cash from loans. We can receive cash from issuing stock, as we saw. But if we receive a significant amount of cash from these financing or investing activities, like loans or stock issuance or investing, it could have implications for the survival of our business operations. That's why we need to show those three sections separately, because they each have different implications. So, can I move on to the next slide? Yeah? No? Okay. Yep, I'm sorry, let me get out of the way here. Did I remove more stuff than I usually do? Is that it? Okay, I'll try to remove less next time. I guess I went line happy. Usually I don't feel like we do that. Sorry about that. Okay. All right. Now can I move on? Okay. So we have two methods for reporting the statement of cash flows. This is what I was getting ahead of myself. We have the direct method and the indirect method. So the direct method shows us the cash effect of each item that's on the income statement. Okay, and that is reported directly on the statement of cash flows. And I wrote here, kind of like a cash basis income statement. So instead of seeing sales, you would see cash received from customers. Instead of seeing general and administrative expenses, you would see cash paid for operating expenses, cash paid for interest, cash paid for dividends. Okay? Or various other things. Actually, I shouldn't say dividends paid. That's actually in a different section. But cash paid for, I meant to say income taxes. Okay? So these things are on the operating section. So in the indirect method, you will see net income. You will always start with net income on the indirect method. Okay? And you derive cash indirectly by reporting net income and adding or subtracting items to convert that to a cash basis. So the difference between direct and indirect is only in the operating section. The other two sections, investing and financing, are the same. The difference is in operating only. Okay? So if you see something that looks like a cash basis income statement, you know you're using the direct method. If you see something that starts with net income, you know you're using the indirect method. Now, what do you think if you had a, I don't know, well, actually, let me flip to the next one, and then I'm going to ask you this question. Can I move? Yeah? Okay. In summary, I have this here. I just want to mention this. So in summary, operating, think net income, think current assets and current liabilities. It just kind of summarizes this stuff. Investing, think non-current assets. Financing, think non-current liabilities, shareholders' equity, and dividends paid. Okay? It's reported for each period. So here, we have direct and indirect methods. Where is it? Why is it not coming up? Okay. So the direct method, this is what it looks like. Cash flows from operating. Cash received from customers, cash paid for administrative expenses would be the direct method. Indirect method, start with net income and adjust net income for non-cash effects. Okay? So basically here, you have a net income number that's on the accrual basis, and you're adjusting it to cash basis. That's what you're doing. Taking out everything that doesn't affect cash. What do you think, just looking at these two, what do you think benefit is to one over the other? Yes?
You're
For the direct method or the indirect? Which one are you talking about? Indirect is more specific. Okay. It gives you more of a breakdown. Okay. Other thoughts when you're just looking at them? There's no right or wrong answer. I'm just curious what you guys think. Yes? Definitely indirect method is more simple. Yes. Indirect method is definitely more simple to derive. Other thoughts? Yes?
Direct allows you to see where your cash is going, how many months it breaks it out, so you don't know what the customer is.
Right. You don't really, like, increase in accounts receivable. What does that necessarily mean to you? Nothing specific, but this means a little bit more. Is that what you're saying? Right. You get, right. Other thoughts? Other thoughts? Yes?
I know that companies don't always use the direct method. I think indirect is more common to find on financial.
Indirect is definitely much more popular in the U.S. to use than the indirect method. Yes? Right. However, you always should be getting a balance sheet in conjunction with your statement of cash flows. You should always have all of these things to look at together. Yeah.
I think it starts off with the net income. Gives us an idea. It's a starting point.
Right, and actually that's something I was kind of looking for, right? Because if you start with net income, if you are a person who likes the indirect method, a proponent of the indirect method might say that the indirect method gives you your accrual basis and reconciles back to cash basis, right? It like takes you from accrual to cash. This is kind of just straight up cash basis, right? It's just straight up, if you were never to have reported on the accrual basis, that would be your cash basis income statement. And some people say, you know, there's a reason why we report things on the accrual basis. The cash basis numbers are not so useful, right? So maybe, even though this seems really lovely to give all these clear numbers, this is really just a cash basis income statement. We're not really supposed to be reporting on cash basis. We should be reconciling between cash and accrual basis. This doesn't necessarily reconcile back, right? It just gives you straight up what it would be if it was on the cash basis. Okay, and other proponents of the indirect method, right, I heard some good ones. It's a lot easier to prepare. A lot of companies say they don't have the information available to prepare the direct method, so we simply, and I did hear there's a lot more breakdown of information on the indirect method, although a lot of people would say they don't know what that information really means. Increase in accounts receivable, decrease in whatever, you know, not necessarily giving you information that you know what to do with, but it's there nonetheless. So this is, again, direct versus indirect. So what I'd like to do now is move forward. What did I do with my stuff here? Okay. I'm going to skip the IFRS versus GAAP for now, and I want to get into an example so we can just start to make some sense of this and start to get into preparation. So I handed out this handout because I figured most of you wouldn't be able to see this that well, which is just giving us information that we would need to prepare a statement of cash flows. Okay? So we have here a balance sheet and we have an income statement. And I've given you the changes. So I'm saying here on the balance sheet, I'm giving you the changes year over year. Which method do you think this relates to more? Indirect method. All right? So we're going to go ahead and prepare information that would go on a direct method, and then we're going to look at the indirect method, statement of cash flows. Okay? So on the direct method, what you have here, the direct method, you're really starting with your income statement. So you have here an income statement, and you're going to take your income statement, you're going to look at your revenue and expense item, you're going to adjust the related balance sheet accounts to come up with your cash receipt or your cash payment. So again, if you're using the direct method, you're starting with the income statement. That's what you're concerned about under the direct method. You always want to start with the income statement. If you're starting with the indirect method, you're going to start with the balance sheet. Once you have your net income number, you obviously start with net income, but you're kind of focusing more on balance sheet. If you're using the direct method, you're going to start by looking at your income statement, and you're going to find the related balance sheet account to determine what your cash receipt or payment is. So let's find out what that means. So in this example, what is sales in the beginning? What is sales, as of the end of the year? $590,000. So here, sales is related to which two accounts? Well, really it's related to accounts receivable. Okay? Sales is really related to accounts receivable, right? Do you understand why that is? If you make sales and you don't receive cash, where does it go? Accounts receivable. So you have really one of two things happening when you make sales. You debit cash and credit sales, or you debit accounts receivable and you credit sales. Okay? So in this example, when you find the related account, so you're looking at sales here, you have $590 in sales, and you look down in your balance sheet, and really what's related to that would be accounts receivable. Got it? So accounts receivable had a beginning balance of 40 and an ending balance of 60. So here, we have a beginning balance of 40 and ending balance of 60. We assume that we would have, for these $590 in sales, we would have debited accounts receivable for $590 and credited sales for $590. Okay? Except some of those sales we actually received cash. So how much would we have to credit accounts receivable for to get to our ending balance? $570,000 to end up with a $20,000 increase. Would have had to have been credited to AR and debited to cash. Okay, I'm going to go over that again. This is how we come up with cash collected from customers. So you have sales of $590. Okay, for the period. Accounts receivable went up by $20,000 during the period. You see that? So a very, very, quick way of doing that, which I don't want to, for those of you who, let me do this very quickly and then I'm going to go through the long process. So if your sales are $590 for the period and accounts receivable went up by $20,000, the idea is that you made sales of $590, but you still are owed $20,000 of that, right? So how much cash must you have received? $570. You have to subtract it. If accounts receivable goes up, you didn't receive that cash, therefore sales is at $570. Okay, cash collected, is at $570. The journal entry way of looking at this, or the T account way of looking at this, is you have sales of $590, so you make this assumption that you have a journal entry to accounts receivable for the $590. Okay? Because the idea is more, you just have to make these assumptions when you're looking at a statement of cash flows as you're learning it in the beginning. You assume that nobody's paid you in cash, as of just right off the bat for this journal entry. Then you have to say, but my beginning balance in receivables was 40. If I add $590 to that, I'm at what? $630. But my ending balance is only 60. How did I get to my ending balance? I must have had to credit receivable and debit cash for how much? $570. Okay? Therefore, cash collected is $570. Okay? Cash collected from customers is $570. So in order to figure out cash collected from customers, the process is you have to look at the sales and you have to find the related balance sheet accounts. And then you have to make an adjustment for whatever the related balance sheet account is telling you. So in this case, accounts receivable went up, therefore cash collected is not that entire amount, it's less. If accounts receivable had gone down, what would you have assumed? You have to add it, right? If beginning accounts receivable was 60 and ending was 40, then it would be 590 plus another 20. Okay? So again, this is not, and this is what I'm going to tell you, this is not about memorization. This is about understanding what you're doing. You will never, ever be able to do this if you try to memorize it. This is all about trying to intuitively understand why you're doing what you're doing. Telling you, I've taught this like many times, and every time people say, you're right, when I tried to memorize it, I couldn't figure it out. When I tried to think about it, I can figure it out. Okay? So this is really going to require you to think and try to understand why you're doing something, not just trying to memorize a formula, because you will never be able to do this doing it that way. So again, you make the assumption when you have a sale that no one's paid you in cash. You look at your change in the related balance sheet account. Okay? I'm showing you T accounts here to make it extra simplified and stepwise, but you could just as easily have, if you understand, sales is $590, accounts receivable went up by $20,000, therefore you couldn't have collected it all. Then you have to reduce cash. Your cash collected goes down by $20,000. Okay, from sales. Any questions on what I've said? Did you learn this already? Did you learn this a different way?
We have a form.
You have a formula.
Sales minus taken accounts receivable.
Okay. But I'm taking you through, I'm trying to get you to intuitively understand why you're doing it. So at least that formula is like completely coinciding with what I'm showing you.
Yeah.
Okay, is everyone with me here? Okay. So let's continue along. How much I want to get into this. I'm thinking that, let me go into cash paid to suppliers, and then we're going to do an exercise. I'm going to kind of go a little out of order. All right. So cash paid to suppliers. So here's a little bit of a formula, if you like formula. So you have to look at, you have to add any increase in inventory. But again, this is not, I mean, ultimately you're going to have to understand this. You have to add an increase in inventory to come up with your cost of goods sold, subtract any decrease in inventory, add a decrease in accounts payable, and subtract an increase in accounts payable. I don't know how far this is going to take you, but this is what you have to do to come up with, to adjust your cost of goods sold, the cash basis. Yeah.
Isn't there
What?
either an increase or a decrease?
Right, you have to add any increase, or you have to subtract any decrease. You have to add any decrease in payables, and subtract any increase. So if you have cost of goods sold, okay, and accounts payable went up, you have to add that to your total cost of goods sold to come up with cash paid.
That's the way it looks like you add the increase and then you subtract it.
No, you have to do all. You have to do one. You may have to do one or the other of these things. Okay. All right. I want to go slowly through this. I need to figure out how to. I feel like I've lost everyone. How many of you are totally lost, or not totally lost? What? Where? Like, I'm not sure where. I just feel like I'm. Yeah. You add the decrease. Yes, those are the options you have. Yes, these are the options you have. So how many of you are not? I mean, where am I losing people, or are you not lost? And I'm just thinking you are.
So we're just trying to find out how to...
Cash. So you figured out we went through cash paid to customers. Now next is cash paid to suppliers. We have to look at. We're going to look at cost of goods sold. Ready? All right. So I think what I'm going to do here is I'm going to skip here. So cost of goods sold was how much? How much was cost of goods sold on the sheet I gave you? 300,000. So you have to start with cost of goods sold. What happened with accounts payable? Right. So you have to, right? Yeah, you have your cost of goods sold. What did I say to do with an increase in it, with a decrease in accounts payable? Add it. Okay, accounts payable went down. You have to add it. So here, you have cost of goods sold. You have accounts payable that went down, and I said also look at the related inventory account. What happened to inventory? It went up. And an increase in inventory has to be added. So if you have inventory that went up by 14,000, your total cash paid is how much? 319 paid to suppliers. So if I scroll to the end, your cash paid is 319. So what happened here? Now let's try. So looking at the formula, we can get to 319. Let's figure out what happened. Cost of goods sold for the period is what you theoretically, right, is the inventory that you sold. Okay? So you always start with that number. Okay? If inventory went up, that means in addition to what you sold, you also bought more inventory. Right? If net, even with some of that inventory going into cost of goods sold, inventory still went up, that means that you must have bought even more inventory than you sold. That makes sense? So that has to be added to what you paid suppliers. Right? Okay, that is to be added to the amount paid for the period. Okay, and if accounts payable went down, what does that mean? I even paid more. Maybe I had some inventory that I bought last period that I didn't pay until this period. So it was sitting in my accounts payable. So now I paid it. That means that cash paid to suppliers went up. So both of those have the effect of increasing the amount paid to suppliers. So cost of goods sold, add any increase in inventory, and add any decrease in accounts payable. Because in all of those instances, the idea is that you paid your suppliers more of the money that you owed them. Okay? You purchased more inventory. Yes?
So accounts payable is only used for purchasing inventory?
The idea is that this is why, now in a book, what I'm teaching you, yes. The reality is that that's not really always the case, which is why a lot of people, companies say they don't track information. It's not easy to put things on the direct method because this information is not necessarily so clear-cut. So I'm showing you how to do it I'm showing you how to do it in the book-wise, okay? This is the process that you would have to go through, but the reality is that a lot of companies can't pull this information apart so easily.
So we're like probably never going to be doing
You actually, maybe if we end up going to IFRS, because IFRS will require you to use the direct method. Okay, so I can't say that you'll never be doing this. I have seen direct method cash flows, but I don't see them frequently. Okay, some companies use the direct method. Most of them use the indirect method because it's much more simple. Okay, but you still have to understand and be able to learn the direct method. And I'll tell you, most people don't know how to do the direct method, which is why I think a lot of people don't do it. Okay, but you will learn how to do this through this class. You will be doing this. Yes. Does someone else have a question? Okay. So cost of goods sold. I want to go through that again. If accounts payable goes down, that means you paid something. If you paid something, that's reported as cash paid. You make these assumptions that cost of goods sold, you paid everything in cost of goods. You start with that whole number there. Okay? If cost of goods sold, if inventory had gone down during the period, we say what? What would you do? You would subtract it from cost of goods sold. So you have this cost of goods sold number. We can't try writing this out. So if you have cost of goods sold, it's like you start off this, it's like this bubble. This is your cost of goods sold for the period. It's made up, all your inventory becomes your cost of goods sold. Okay? If inventory decreased during the period, if inventory went down, that means the idea intuitively is that you didn't buy anything during the period. You used last period's inventory. Does that mean that you paid anyone this period? You didn't pay for that, right? So you would subtract that from cost of goods sold. That would come out of the cost of goods sold number that you're going to report. Okay? So you have an inventory number, and the idea is you could have used all of last period's inventory, stuff you paid for last period, stuff you bought last period, not bought anything new. Okay? And all the inventory that comes from last period that you sold in this period, that you didn't, forget even paying at this point, okay? Let's keep it really simple. All the inventory that you get in each period you pay for in that period. Okay? So in a really simple world, if you used only the inventory that you paid for last period in this period, did you pay any suppliers? So I'll put some numbers. If you had inventory of $100 rolled over from last period, and you sold $50 of that inventory in this period, how much was paid to suppliers in this period? 0, because you paid for it all last period. Okay? So if inventory, here you're taking out some of this is all coming out of the prior period's inventory. Okay? So the idea is that if and what's going to happen to your inventory balance when you sell that $50 worth? It's going to decrease. So if inventory goes down, then cost of goods sold, then the number that you're going to report for cash paid goes down, because you are just taking inventory that you had already from last period and paid and using it up in this period. Okay? Separately from that, you have accounts payable. So so now complicating this world a little bit, some of that $100 in inventory from last period may not have been paid. So when accounts payable goes down, that means you paid some of it. So you have to always start with this bubble of cost of goods sold and say, what happened to my inventory and what happened to my accounts payable? Both of those play in to what your ending balance is going to be in what you paid to suppliers. Okay? So if accounts payable goes down, that's an easy one. I paid people. That means it increases the amount that cash paid to suppliers. If inventory goes up, the idea is I bought more. Okay? And also, you assume for the purposes of your cash flow statement that was also paid. Okay? So that would take you to ending cash paid to suppliers, which is here. So now we've gone through this. We've gone through this. I'd like to do an exercise and then come back to these last three. Oh, we don't even have time to do an exercise. Class is like over, isn't it? That really stinks to go through all that and not even do an exercise. All right. All right, you know what? We'll start on this next time. I will probably go back over this again. I want to look at that formula to make sure that I hopefully can reconcile that for you. And I'll probably open up a homework, balance sheet and cash flows, and we'll continue with this next week. And then we have a test in 2 weeks, I think. Yeah, so great. Fabulous.